My name is Rich Cagle, and I'm with Cypress Business Brokers. We're located in Houston, Texas, and serve Southeast Texas. We help entrepreneurs realize the value in their businesses. This is part two in a series devoted to taking the mystery out of business valuation. In our previous episode, we covered some of the basic concepts of business valuation. In this episode, we're going to discuss how to measure a company's cash flows and how an investor can measure its value. This presentation contains general information about the valuation process. However, it is not intended to give you advice about your own particular situation. You should always consult with your own advisors and should engage a qualified professional to assist in any valuation assessment. In the first episode, we talked about three general approaches to estimating value: the asset approach, the market approach, and the earnings approach. In this episode, we'll dig a little deeper into the earnings approach. Earnings or cash flow approach develops a financial model to estimate value. The underlying theory here is that the assets of the business in total are in place for the purpose of generating cash flow. Their collective value can be determined by looking at cash flow levels generated by those assets. We then ask, what would a willing buyer pay to take control over a stream of cash flows? A company's net income is reported according to generally accepted accounting principles, and it's not the same thing as cash flow. Net income includes expenses like depreciation that are non-cash. They represent a way to spread a cash expenditure over a number of years. Net income is also dependent on the company's capital structure. If a company has debt, there will be interest expense. The form of organization dictates whether or not the entity has provision for income taxes. If the company is organized as a C corporation under the tax code, there'll be a provision for tax. Whereas if the company is an S corporation or a partnership, the company doesn't pay tax. Its taxable income flows through the company onto the individual tax returns of its owners. The form of organization and capital structure of a company are based on what was most advantageous to its current owner. If we're a prospective buyer of a company's assets, we don't care how the current owner organized his company or how his assets were financed. We'll make our own decisions regarding form of organization as it's the most advantageous to us. We'll also choose whether to finance the company with all equity, equity and debt, or all debt if we can find a lender willing to do that. Earnings before interest, taxes, depreciation, and amortization, or EBITDA, is a way of looking at a company's earnings irrespective of its form of entity and capital structure. Let's look at an example. Company A is a C corporation under the tax code. It reports and pays income taxes on its taxable income. Company A is financed with equity. It has no debt on its balance sheet. Company B is also a C corporation, but its capital includes some debt, so it has interest expense. Company C is an S corporation. For tax purposes, it's a flow-through entity. It pays no taxes. Taxes are recognized by the shareholders on their individual tax returns. Company C also has some debt and pays interest. Note that if Company C had no debt, its net income would be the same as its operating income, $2,000. Now, all three companies have identical operating incomes, but their net incomes are quite different. Net income isn't particularly helpful for valuing these companies. It seems that each company's assets should be worth the same, but they show very different net incomes. Net income is skewed by the organization and capital structure of the current owners of the assets. That's where EBITDA comes in. Depreciation expense is non-cash, so we'll add it back in all cases. We also add back interest and taxes for reasons we've already discussed, and we notice that EBITDA for all three companies is identical, as we would expect. In summary, EBITDA can be thought of as the operating cash flow of a business, regardless of whether it is a C corporation, an S corporation, or a partnership, and whether or not it has any debt. We've already covered EBITDA, but let's look at owner's discretionary income. Here's where a bit of detective work comes in. We identify items included in operating expense that are either paid to the owner or were paid at the owner's discretion. An example would be a company car for the owner. Here we're trying to calculate the cash flow that would be available to a new owner or investor to be paid out of the business or retained in the business at the owner's discretion. We add these items back to EBITDA to get owner's discretionary income, or ODI. A company employs assets to generate cash flows. The earnings approach says that the fair market value of the assets can be estimated by measuring the company's cash flows and then assigning a value to those cash flows. To a buyer, the value of a stream of cash flows is highly dependent on how much risk is perceived in attaining future earnings from the purchased assets. One common method of estimating fair market value is to multiply earnings, for example, owner's discretionary income, by a multiple. We might use average ODI over several years or just the most recent. The choice of a multiple is critical to this method. Defining the multiple requires professional judgment to evaluate the risk of investment. At first glance, the multiple seems to be an arbitrary number, but in fact, the multiple is subjective, but hardly arbitrary. So how does this method make sense? Let's look at some of the most important factors that should be considered. How do we go about deciding on an appropriate multiple? The multiple is another way of saying how risky does a buyer or investor perceive the company to be. Every investment involves risk. An investor would require a higher return to compensate for higher levels of risk. So how do we evaluate risk? There are a number of factors to consider here. Let's take a look at a few of them. Number one, revenues. Obviously, revenues or sales are important, as revenues are the source of profits. Level of revenues is important, but we should also consider trends in revenues. Is it growing year over year, stagnant, or declining? How does this company's revenue levels compare with other similar companies? How likely is it that future revenues can be estimated based upon past revenue levels? If a company relies on a few major customers, it is much riskier than a company that has a large, diverse customer base. The loss of even one major customer could change a profitable company into a loser. Repeat business or business coming from referrals of past customers is an indicator of customer satisfaction with the company and its products or services. Looking at accounts receivable collection history can give us a perspective on the quality of customers. High bad debt write-offs indicate a high-risk customer base. After all, a sale is only a sale when cash is received. When someone buys or invests in a business, what they're really buying is the future stream of cash flows or profits. We should look at profit margins, return on sales, and return on investment to evaluate the business performance and compare it with its peers. What are the trends in profits? A consistent trend of increasing profits would justify a higher multiple than a level or declining profit field. Understanding the competitive environment is critical to evaluating the risk to the company's profit trend. How likely is it that a new competitor will enter the market? Are there barriers to entry that would make it more difficult for a new competitor? Is there something unique about the business being evaluated? How does a company position its products or services? Is it a premium product or a discount brand? Yet another factor to consider when setting a multiple is how reliant the business is on its owner. Does the company have written procedures and processes, or are they carried around in the owner's head? Are customers and suppliers loyal to their relationship with the owner or to the company's products and services? Is there a management team in place to operate the business in the owner's absence? Could a buyer expect that the owner will be cooperative during the transition? In a sale, is the owner willing to partially finance the deal? This chart illustrates how multiple is really a surrogate for return on investment. What the curve tells us is that as investors perceive more risk for an investment, they'll demand a higher rate of return to compensate them for risking their money and time. One thing that jumps out is that ROI on this chart is considerably higher than what one could achieve in the stock market, the bond market, or real estate. Ownership of privately owned small to middle market businesses is much more risky than most other investments. Publicly traded stocks and bonds are highly liquid. They can be sold on the public market almost instantaneously. Real estate, while less liquid, has historically been more stable in value. Small business is risky for a number of reasons. One, because it is illiquid. Selling can take much longer and cost much more than selling stock or real estate. Another method often used in large business valuations is the discounted cash flow method. I won't go into great detail here. We'll cover this method in another episode. But here are the steps to performing a discounted cash flow valuation. First, we project future earnings, typically over 5 years, but could be longer or shorter. Then we estimate a selling price for the business at the end of the projection timeline. Then we determine an appropriate discount rate. The discount rate represents a risk-adjusted opportunity cost of capital for a prospective buyer or investor. Then we calculate the present value of the projected cash flow stream. That present value would be our expectation of the value of the future cash flows. To summarize, the earning approach states that the value of a company's assets can be estimated by looking at the cash flows generated by those assets. To measure cash flows, we would adjust reported net income for non-cash items, for expenses at the owner's discretion, and for expenses related to the company's form of organization and capital structure. Since a prospective buyer is really buying future cash flows, we evaluate the risk that the current cash flows are not representative of future cash flows, and calculate fair market value to compensate for perceived risk. Thank you for your time today. I hope this has been informative. In this episode, we looked at some ways to put a value on earnings. In future episodes, we'll take a look at discounted cash flow model and financial statement analysis. Then we'll put it all together with a valuation analysis of an example company. If I can offer any assistance, please feel free to contact me. Visit us on the web or on Facebook. I'd love to hear your comments and any suggested topics for the next program. If you'd like to be informed when the next presentation is available, please send me your email address. I promise to respect your privacy and I'll never share your information with anyone.